go ahead and get started. This is Craig Pritz from JRG Advisors. This is the next installment in our WebEd series, and today we're talking about creating funding strategies. We're really going to be focusing on today health savings accounts, which we'll refer to as HSAs, flexible spending accounts, known as FSAs, and health reimbursement arrangements, or an HRA. First, I do want to welcome some of our valued clients and partners. Thank you so much for joining us today. And I want to introduce a special guest joining us today. Today we have Joe Renaud from HSA Bank on the line with us. Joe has a lot of history in this industry and brings a lot of knowledge to this webinar for us, so we want to thank Joe for joining us today. And real quick housekeeping. Any questions, please type those in the upper right-hand corner. I'll save you one right off the bat. We will be sharing a copy of the webinar, as well as the PowerPoint presentation and all the questions and answers. And we'll be answering the questions at the end, and then we'll provide you a copy of those questions and answers. So let's go ahead and get started. The agenda for today. Again, we're going to cover three types of spending accounts: HSAs, FSAs, and HRAs. We'll talk a little bit about the history of the accounts, how these different accounts work. We'll talk about how they can influence consumerism. And lastly, we're going to talk about how these accounts can work together, and that you can have multiple accounts, more than one type of account together. So first, let's talk about the most common or most used account today, the health savings account, or the HSA. HSAs were created back in 2004, and really they were created at that time to replace the old medical savings accounts. Today there's about 13.8 million people using a health savings account, and I will mention too that those numbers are increasing at a much more rapid clip now than they were in the beginning. So these accounts are really growing in popularity. Really, an HSA is a savings account that is designed for your medical expenses. And these accounts are available both to people with group health insurance and non-group health insurance plans. Joe can comment just a little bit on how a group and non-group HSAs differ, but they very much work alike as well. Joe, if you wouldn't mind.
That's true, Craig, and thank you very much. HSAs can be offered to a group, or it can be offered to an individual who basically has a high deductible health plan. And the qualifications from a carrier perspective that determine whether a plan is or isn't a high deductible health plan is many times the carriers will say that this is a HSA compatible high deductible health plan. And if they are indicating that the plan design that they are offering meets that criteria, that is all that is needed to establish an HSA program. As Craig also mentioned, this is probably one of the most fastest growing areas in the health insurance industry to date. And primarily the main reason for the interest in these types of programs is because as these high deductible health plans are becoming more and more available, more and more people are being asked to pay for services which in the past might have been covered under their group health plan or their individual health plan. But now you can use the health savings accounts, which are a very, very nice program to be able to put together, because it allows you to do certain things within those programs. And we'll be talking about those in future slides. Would that help, Craig?
Yes, thank you, Joe. So as Joe mentioned, in order to have a health savings account, you do have to have an IRS-approved health plan. We refer to those as qualified high-deductible health plans. We love initials in this industry. You might see QHDHP as well. There are some other requirements that you have to meet, just a couple of those, or just some of those. There are more than what's listed here, but you have to be a U.S. citizen. You have to have a valid Social Security number. Can't be claimed as a dependent except by a spouse. And you cannot have access to TRICARE, which is the military insurance, or VA medical benefits. And again, these are just a couple of the guidelines. There are more that you should definitely talk to us about. But the real benefit of a health savings account. The benefit of setting up a separate account to pay for your medical expenses is what we often refer to as a triple tax advantage. The money that goes into the account can be funded by anybody, but when it's put in there by the account owner, that money goes in on a pre-tax basis. Once the money is in the account, it has the ability to earn interest and grow. You have two options there. That money can earn interest at a rate that's similar to a savings account, or you can invest the money that's in the health savings account into different investment options. Now, those options are not insured. They're not FDIC insured, so there is the risk for loss there with those investment options. And one thing that's very, very important, different financial institutions will offer different options for you to invest in. If it is something that you are interested in, sometimes finding the right options can make all the difference, and that's something we can help you with as well. And the last tax advantage and the triple tax advantage is when you use the money in the account to pay for what's known as eligible medical expenses, you don't pay any tax on that money. Now, for the best list of eligible expenses, we always refer people to irs.gov. We see a lot of businesses moving to this model, and businesses approach this differently as far as how they may or may not be involved in the HSA account and contributions. Joe can provide us just a little bit of insight on what he sees businesses doing today.
Thanks, Craig. That's a great point. Today in the marketplace, we're finding a host of different options that are being made available to individuals. Number one, if they're working for an employer, the employer may be contributing on behalf of anyone who participates into an HSA, into their HSA account. And by contributing, the employer is taking an active role to help and assist people with funding their HSA accounts. Another very important consideration is the fact that we also find if there is no contribution on behalf of the employer, that the employer is willing to do payroll deductions for those employees who do elect an HSA type of program. The benefits, as Craig initially mentioned, are tremendous. Number one is, obviously, if everything is done on a pre-tax basis, obviously, if the employer is contributing, there's tax advantages to them because there's less in the way of federal, state, and FICA types of taxes that the employer is paying. Because again, monies going into an FSA are going in on a before tax basis, which means the person's earning the same, but they're reporting the less for purposes of taxes. Same thing is true as if the employer is doing things on a payroll deduction through some type of a pre-tax type of an arrangement. The employee sees a reduction in both their federal and state taxes as well. So there's a tremendous benefit if the employer contributes or if the employer is making the payroll deductions on behalf of the employee as well. Craig mentioned another very important part as well, and that is individuals can set up their own HSA types of programs in which when they decide to do that, whether they pull the money out of their checking account, their savings accounts, or whatever medium that they choose, they still see a tax benefit for being able to do that. So we're seeing many different combinations in the marketplace, and it's good, as Craig mentioned, to be informed as to about what those advantages might be, whether they're being done through your employer, whether they're being done through your employer by a payroll deduction, or whether they're being done by an individual through some other medium, whether it's being taken out of their checking account or their savings account. So by all means, if you have questions about this, please touch base with your JRG advisors. They can definitely be of benefit to you.
Thank you, Joe. We're going to talk a little bit about some of the limits and requirements. You know, the IRS and the government is creating a vehicle to put money aside on a pre-tax basis, creating a tax shelter. There are some limits. And in 2015, and these are adjusted periodically, they're increased cost of living increases, but for 2015, an individual they contribute up to $3,350 into their health savings account, and a husband and wife or family can contribute up to $6,650 into the account. I will mention here that we're giving you some high-level information right now. If you have somebody who changes mid-year, you have an employee whose spouse loses coverage and joins your group plan, that changes things for them. It's important that you reach out to us. There are strict rules on the money that goes in there, and any overages will be subject to taxes. So it's important if you have changes that we talk those through with you. We mentioned earlier that one of the requirements is the plan must be a qualified high deductible plan. And there's a whole list of IRS requirements a plan must meet to really be considered a qualified plan. One of the biggest ones is the deductible. For an individual, in order for a plan to be considered qualified and therefore eligible to have a health savings account, the individual deductible has to be at least $1,300 or higher. The family deductible has to be at least $2,600 or higher. And you'll see that the insurance companies will offer different deductible amounts that are HSA eligible. They've put the plan through the test and determined it's eligible for us. One thing I want to mention, I apologize for failing to mention this. When it came to the contributions for an individual and a family, any person's 55 years or older does have the ability to make an additional $1,000 a year contribution into their HSA. They refer to that as a catch-up contribution. And it's also important to know at this point, too, to talk about that these HSA plans are not use it or lose it. This money rolls over year after year, and this money belongs to the employee. They will not lose this money. These plans, these health savings accounts, can be rolled into a qualified retirement account if there comes a time that you are no longer eligible to put more money into the HSA account. So there are some options there. And you also have the option to continue to run out that money paying for eligible medical expenses even after you're no longer eligible to put money into the account due to not having a qualified plan. So we're going to talk a little bit about what the benefits are. And we've been mentioning them here and there as we go through this, but let's really focus on what the benefits of a health savings account are for both the employers and the employees. First thing is most employers will recognize a lower monthly premium versus a plan that is a richer plan or maybe a first dollar coverage plan. You know, when you move from a plan with a zero or low deductible to a qualified plan, there is savings to be recognized in the monthly premium. If the employer and employee are sharing in that cost, then they're both going to recognize some savings. There are tax advantages for the employer as well. Joe is not a tax advisor. He does not play one on TV, but he can comment on just a couple of the tax advantages that a business sees with a health savings account. Joe?
Thank you, Craig. Many times with the employer, the tax advantages they primarily see is whenever a person establishes an HSA and there's contributions, as we talked about beforehand, that the employer is making to individuals' HSA's accounts, they are seeing less in the way of taxes that they would pay on that individual in the way of federal, state, FICA, and even to some degree workers' comp costs, because while the people are reporting or making, the same amount of income, they're reporting less because of the fact that there's tax advantages of being able to contribute to an HSA type of a program. In addition to that, since the employee is also seeing benefits by being in an HSA, they too are seeing their federal, state taxes be less as well. So the win-win situation for both the employer and the employee is that when an employer allows their valued employees to participate in an HSA program and they are contributing, they see a tax benefit as well as the employee does. And in some studies, in some reports that have been shown, that total amount of savings could be anywhere from about 13.7% or maybe even a little bit more, depending upon what the situation may be. So again, there are tremendous tax advantages for being able to offer these types of programs.
Well, thank you, Joe. One of the other things that these plans really do, and this is by design, is they promote consumerism. And what we mean by that is a qualified high deductible plan, by design, by nature, will have more upfront out-of-pocket costs. And that's really what the health savings account is there for. It's the vehicle to use those pre-tax dollars. But when we're told that we have to pay for something at full cost, not at a fixed copay, it makes sense for us to become smarter consumers. It makes sense for a lot of different reasons. Example, doctor advises you to have a certain test, and you can go to 3 or 4 places to have that test, but what you don't know is how the costs vary. The truth is costs vary greatly between facilities when it comes to things like that. And there are better tools out there today. The insurance companies recognize this, and they have provided tools that people can utilize to find the best cost and best outcomes for things that they need, procedures. By doing that, number one, a person's going to have less out of their pocket, but the insurance company is also going to pay less, which is going to have a positive impact on rates and claims long term. So this was all by design with the qualified plans to promote consumerism and to really create smarter shoppers when it comes to our health insurance. But the big benefit to the employee is if they have the out-of-pocket cost anyways, it benefits them to use pre-tax dollars to pay for those expenses. And lastly, I mentioned this earlier, but just to reiterate, a lot of people are familiar with the words use it or lose it. A health savings account is not use it or lose it. Any unused funds roll over year after year. That account increases in size year after year, it can. And if the time comes that you no longer have a qualified plan, you are still eligible to use that account to pay for medical expenses, or it can be rolled into a qualified retirement account. So that's going to wrap up just a little bit about the health savings accounts today. Joe, was there anything that you wanted to add there before we moved on to flexible spending accounts?
Well, yes, Craig. The one thing that I would just like to mention to the audience is the fact that the HSA program in and of itself is one of the most attractive things for individuals who are now becoming responsible for their health insurance costs. And as Craig touched upon it, when you pull monies out of an HSA account to pay for those types of eligible expenses, there is no tax consequences. The other thing is the fact that there are multiple ways that people can pay for those types of costs that may be his or her responsibilities. They can pay it by way of a debit card. They can decide to pay that expense out of their own pocket and then be reimbursed. And depending upon the organization that you choose, those monies can be reimbursed back to the individual in the form of a check. They can be reimbursed either directly into their checking or their savings accounts. But what's really important here is the fact that these programs are the account holders' monies, and the fact that we make it very easy in which to reimburse or to pay for those type of expenses that may or may not be incurred. The other nice thing about this is, as Craig touched upon, is the fact that it's not a situation where it's a don't use it or lose it type of a situation. With an HSA account, if you don't use the monies in the HSA account, they just continue to grow and they continue to earn interest year after year after year after year. So there's tremendous benefits for the account holder, maybe later on in life if they're wanting to use this as another type of a retirement vehicle to complement the other types of retirement programs that they may or may not have. So the advantages are tremendous in the fact that You can use these monies, as Craig touched upon, for those medically eligible expenses that they can define for you, that they will show you what those are. But it works very smoothly, very efficiently, and for many people, they find it to be a tremendous benefit to them in managing and paying for those kind of costs that they are now responsible for under these high deductible health plans.
Excellent. Thank you, Joe. So let's move on to flexible spending accounts, and this is just another type of spending account that is available to employers. It is similar to the health savings account in that you're using pre-tax dollars to pay for qualified medical expenses. But that's really kind of where the similarities end. They're different. The flexible spending account is different from an HSA in that it does not require you to have a qualified high deductible plan in order to use pre-tax dollars. And actually, it's often used with what we refer to as more traditional plans. It's not uncommon to see a company with a lower deductible, not a qualified plan, utilizing a flexible spending account. Where they are also different than an HSA. An FSA is set up by the employer, and it is not owned by the employee. The employee does get to determine how much they want to contribute to the account, and the contributions are taken out of the employee's paycheck based on the payroll frequency. So an employee determines how much they want to contribute yearly, and depending on how many times an employer has payroll set up, that's how many times it'll come out of that employee's check. Now, the one thing that is kind of interesting with an FSA is the full amount of funds are available immediately, meaning that if somebody needed to use those prior to the total amount being in there that they wanted to put in for the year, because they've only contributed a couple paychecks worth into their account, the full amount would be accessible to them. With a flexible spending account, you can make changes, but only if there's a qualifying event. And this really ties into the use it or lose it rollover part and how important it is to make sure that you really think through the FSA and try to put the right amount in there. And what I mean by all that, up to $500 can now roll over in a flexible spending account. So the government has changed the use it or lose it rule to let you roll over up to $500, but you still do lose anything above and beyond that. And you can only make mid-year changes if there is a qualifying event. So it's very important when setting up a flexible spending account to try to accurately determine how much money to put in there. And there's some great tools to do this. Joe, would you mind commenting on some of the tools that are out there to help people figure these out?
Well, that's a great point. Many of the organizations who offer these types of programs have calculators that a person can utilize to determine what his or her costs could be in a particular type of a calendar year. For those people who are maybe using this for the first time, what's usually the recommended procedure is to put in a very small amount until you can get a good idea of what your health care cost may be building towards month after month after month. The other nice thing that's occurring is for many people, they may use their past year types of medical experiences as a determinant to plan for the next year. So again, if they can get those types of pieces of information, we have calculators that they can put those numbers in there, and that would give them an approximate idea as to what they should be funding into their FSA for purposes of knowing what expenses they might have, and more importantly, how they can be reimbursed under the FSA arrangement.
Thank you, Joe. And we talk about expenses. It's important to note that, like the health savings account, there is a list of eligible expenses that you can use your flexible spending account for, and there's even different types of flexible spending accounts. In a minute, we're going to touch base on some different types like dependent care and transit and parking. But there are different types of flexible spending accounts, and there are lists of qualified medical expenses. And just like the HSA, we often refer people to irs.gov for the most accurate list of what is considered a qualified medical expense. We based on the medical flexible spending account, but there is also a dependent care flexible spending account. The dependent care flexible spending account, a lot of us often will think of that as care for our dependent children, our young kids, and that is one of the things that you can use the FSA for. I take advantage of that for a child in daycare myself. But the truth is you can also use it for care of a dependent that is over the age of 13 that may be physically or mentally incapable of caring for themselves. You can also use it for care of a dependent adult living in your house. Now, one key word in all three of those bullets was the word dependent. In order for you to use your FSA dollars for dependent care, the IRS must recognize that person as your dependent. So it's very important that the word dependent be in there. Now, dependent care FSAs, unlike a medical FSA, is not pre-funded. You only have access to the funds that have actually been put into the account. So that is a little bit different. And there's even a flexible spending account that could be set up for things like transit and parking. These are just a couple, too. There's limited purpose flexible spending accounts that can cover things like dental and vision only. We're just covering a couple of the more frequently used ones today to get you thinking as an employer. We can always talk about all the other options in more detail when we speak one-on-one. But like the HSA, the government does have some limits on a flexible spending account. And for the healthcare FSA, the government will have a limit of $2,550. For a dependent care FSA, the government limits it to $5,000. Now, it's $5,000 if you're married, filing a joint return, or for a single parent. But the limit for somebody married filing separately is only $2,500. And for the parking and transit FSAs, those limits are not yearly limits, but they're monthly, $250 for parking and $130 for transit. Now, very important to know, these are the limits that the IRS has. Different companies you work with may have different contribution requirements that they have. So as far as they may have minimums that you have to hit. And the employer as well can also impose a limit on their flexible spending account. The employer cannot exceed the government's limit, but could put in something lower than what the government has there. Joe, before we move on to HRAs and health reimbursement arrangements, anything you'd like to add on the flexible spending accounts?
No, I think you've done a good job, Craig, of basically identifying the differentiators between an FSA and, say, an HSA. There are these points that have been very clearly stated, but in making a decision as to which plan best work for you, it is important that you seek the help and the advice of your JRG professional because, again, designing of these programs can be very, very important, but also it wants to be done with a specific objective in mind. And for many people, an FSA could be a good way to be able to go, especially if they're in a situation where they have expenses and they want to get those reimbursed. However, for those people who see an HSA as being a tremendous advantage, it's good to work with someone who knows and understands that and can help people to make an informed decision as to if that's the best solution for their particular situation. But I think you've done a great job in covering it so far, Craig.
Thanks, Joe. So, you know, we're talking about creative funding today, and we're talking about different things that employers can do. The last thing we want to talk about today is a health reimbursement arrangement. And with all three of the options we talked about today, the benefits are either for the employee and the employer, just the employee or just the employer. A health reimbursement arrangement really benefits the employer more than anybody. And these can create savings for a business by having an employer who is utilizing a higher premium, a richer plan, maybe a lower deductible, and that employer chooses to move to a plan with a lower monthly premium, which in turn means a higher deductible. Now, what the employer chooses to do now is to take some of those savings generated by moving to the higher deductible and determines how much of those savings they want to use to reimburse the employees when they utilize the insurance. This works well in some cases and doesn't in others, and it's really driven by a lot of different factors. It's driven by the type of plan you're using today. It's driven by the difference in price the insurance company is offering for plans that have higher deductibles. But when it works out, the one nice thing about this is the employer knows going in what their worst case out-of-pocket is. They also know what their best case savings is, depending on how their employees use the insurance. So when we work the math, we are able to tell an employer if this makes sense or not, and if it does, what their greatest potential savings is, but we can also determine what their worst case scenario is, and we can put caps on that so it does guarantee some sort of savings. The employer has the ability to determine what benefits are eligible to be paid under an HRA, but very different than an HSA, these funds stay with the employer. These are not employee funds, and they are not reimbursed to the employee if they're unused. What we find is with a health reimbursement arrangement, this may be administered by the insurance company directly, or it can be administered by a third-party company. Now, third-party companies are going to charge a fee to do this. They've got to make some money as well. And sometimes third-party companies may require the account to be pre-funded, or they may allow you to fund it as the claims occur. So there's differences there that it's important to know what the different companies are doing. There also may be restrictions from the insurance companies these days, and we're seeing that some insurance companies have stopped administering health reimbursement arrangements, HRAs, altogether. Others have placed some restrictions on what plans they'll make eligible and how much an employer can reimburse. So it's very important to talk to us about this concept and the best way to go about this. But the truth is, unlike a health savings account and somewhat a flexible spending account, a health reimbursement arrangement really does not promote consumerism. It does not create smarter consumers. It doesn't educate your employees to utilize their insurance better. And it does not have a positive long-term impact on health insurance costs. The truth is employers just aren't motivated to be smarter shoppers with an HRA because it's the employer that's reaping all the benefits from an HRA. Lastly, we want to talk about how you can utilize as a business one, two, or even all three of these different types of accounts. The truth is they can really work together. One of the things that Joe really brings to the table for us is his knowledge of how these can work together, coming from a company that integrates all three. And Joe, if you wouldn't mind, tell us a little bit about the concept of the one platform and the three of these working together.
Well, that's a great point, and it's a great entree into what you're talking about here, Chris, and the fact that in today's market, we are finding that employers and organizations are asking very, very intelligent questions about, Joe, can I have all three of these? Can I have an HSA? Can I have an FSA? Can I have an HRA? And the answer is yes, you can. There is some caveats to that, though, and that is if you're going to offer an FSA, it can't be what's commonly referred to as a full-purpose FSA. It has to be changed to reflect what's called a limited-purpose FSA. And the primary reasons for that is because an FSA pays some of the same medical expenses that an HSA FSA does. So the IRS is very clear that if you're going to offer all three, you do have to make a change in your FSA program from being a full-purpose FSA to a limited-purpose FSA. The other very important part about if you're offering all three of these types of programs is for many employers, they may have one administrator that handles, let's say, their HRA and FSA. They might have another administrator who handles the HSA. But what we find in the marketplace is the employers are saying, look, is there an organization who can handle all three and by the same token provide one debit card that an individual can utilize? And the answer is yes. We are an organization that can provide that service and that capability. And the nice thing about it is, from the individual's perspective, they don't have to get involved as to which one should pay out first. We have built in logic within our platform that allows to do that. We also have the capability of being able to turn off certain things. And case in point is this. An employer may have a lot of high net worth individuals who are using, let's say, the HSA as a tax deduction. And they have the wherefore-alls to be able to pay for those types of medical expenses out of pocket. They may want to not to use, or they may want to not use the monies in their HSA accounts. And the question was asked, for these high net worth individuals, can you turn off that ability? And the answer is yes. But from the consumer's perspective, the fact that you can have one card to be able to manage and to handle these different accounts is a huge, huge benefit. And one of the other things that's important about that is the transparency and the accountability. With our platform, account holders and employers, if they're utilizing our services and capabilities, have the ability to be able to go in and see every transaction that's occurring. Now again, employers can't see account holder information because that's protected and that's private information. But employers can see such things as, like, if they're contributing to the HRAs and FSAs and HSAs, they put up contribution schedules. They can look at demographic information to see, you know, how many individuals are participating. They can look at certain things as like how many female, how many male, how many singles, how many full families. They can even look up certain types of diagnosis codes to see what types of diagnosis codes are being reimbursed. On the account holder side, they can see such things as what their account balance is, what transactions have taken place, and what is remaining in their accounts. And the other thing that becomes very important here is, in today's society, many people are mobile, and no one wants to be able to carry receipts in terms of hard copies with them. With our system, we have a mobile app, which allows people to take pictures of those receipts, and they can be uploaded into our system in the form of a PDF and be reimbursed very quickly and very efficiently. Many times it could be in less than 2 days. So again, now you have a platform that allows both account holders and employers to see transactions that are occurring, and they can also upload and download files rather than having to have many different administrators handling this and doing this for them. So from an employer's perspective, it's much easier, much simpler in which it's worked. From an account holder's perspective, you now have an organization who can manage this process for you, but manage it in a very simple, a very efficient manner with the transparency, which is huge. So again, we're seeing that in today's marketplace, yes, you can have all three, but as Craig mentioned initially in the presentation, we're seeing more and more of a movement toward the HSAs because of the flexibility, because of the fact that these are account holders' monies. They can take it with them. With the HRAs and with the FSAs, they're still valuable programs, and they do have a specific solution for companies who are looking for those types of services and capabilities. But if you're looking for an organization who can handle all three there are organizations that can do that, and we are one of those organizations that can definitely be of benefit. Has this been helpful, Craig?
Very much so, Joe. Thank you. Thank you. We're going to pull up the questions that we have today, and we're going to go through. We're going to answer those for you now. And again, at the end, we will, within probably the next couple of days, we'll get you a copy of the PowerPoint, the replay of the webinar, and all the questions with the answers provided.
Okay, the first question. To clarify, at no time can an employee exceed maximum contributions. If an employee hits the limit mid-year, would he have to stop contributing until more qualified expenses draw down the account?
So the answer to that question, and I think we're referring there to a health savings account because that is the one that the employee owns and can contribute towards. A health savings account, you are limited with the amount of money that goes in there. And if you exceed the amount that the government has set for that limit, you will pay taxes on the overages. And it's not a matter of just drawing it down to get it under the limit. You're limited on the amount that can go in there in a year basis. So you'd really want to set that up through whether it's a payroll or whether you're depositing money on your own there separately. You just want to make sure you do not exceed the government's limit for that year.
And Craig, that's a great point. One of the things that's also important about the HSA arrangement, especially with our particular program, is there is no setup fees, there is no minimum contribution. Some organizations may require a minimum contribution of some type, but in our particular situation, there is no minimum contribution. So for that individual who wants to establish an HSA, they can start out very small and build as their medical needs continue to grow. But you're quite right on the fact of the other part, which is anything above and beyond the single and family maximums, there would be a penalty as well as there would be a tax on anything above those stated contributions that you already mentioned.
Okay, the next question. Can money remaining in an HRA be rolled into qualified 401k each year or only when the employee terminates?
So to answer that question, I think we have a couple different things coming into play here. An HRA is a health reimbursement arrangement that is owned by the employer. Some companies will require that to be pre-funded, and some will allow that to be funded as it goes. But the HRA is the account where when the employee's claim comes in, the employer pays certain predetermined claims up to certain amounts. I think we might be referring to the HSA here that I mentioned that has the ability to be rolled over into a qualified retirement account. And in that case, so what happens with an HSA is it is owned by the employee. And if an employer chooses to no longer offer a qualified high deductible plan, that is a time when that employee can choose to keep the HSA and continue to use the funds out of it, or they can roll that over into a retirement account. Let's also say an employee leaves a company. At that point in time, that employee still owns that HSA. At that time, they have the choice of keeping that HSA. Their next plan they buy through another employer individually might be a qualified plan that would allow them to continue to contribute to the HSA, or they may just use the funds that are in the health savings account, or they can roll it over. The truth is an HSA is owned by an employee, and that's something that they can do at their discretion. It doesn't have to happen if employee leaves an employer. They can keep that HSA open after that.
The next question. Are the contribution limits of $3,350 and $6,650 for an HSA inclusive of employer and employee contributions?
The answer is yes. The total amount an individual can have in their account, placed in their account, is $3,350. Now, that doesn't mean that's the total amount they can have in their year after year, because it can earn interest and grow. That's the most that's allowed to be put into their account in that year. The account can be funded by the employee, the employer, or really any third party. You could have other people. Boy, wouldn't that be nice if we all had people putting money in our HSA accounts for us, but the truth is that can't happen. It's still capped. It's still that cap, no matter who's putting the money in there. That is the cap. And again, keep in mind that changes. Sometimes it changes every year. Sometimes it's every couple years. It gets reviewed yearly and can be adjusted yearly.
The next question. My company currently has a PPO plan that the company pays 100% of the employee's deductible. With an HSA, does that minimum required deductible have to be paid by the employee, or can the deductible be paid by the employer?
So what we're referring to here, if a person has an HSA plan, an HSA account, they would have to have a qualified high deductible health plan. The truth is they can use the HSA to pay for that deductible, and it could be money in the HSA that came from the employer originally, or it could be the employee's money, a third party, or any combination. So looking back at this question, the answer is that it can be paid by the employee or the employer. If we're talking about an HSA, really either one can put the money into the HSA account.
The next question, what is the process for reimbursing qualified medical expenses through an HSA? Who handles this?
Great question. And the answer is it varies a little bit between financial institutions on exactly how they handle it. But in most cases, when you set up a health savings account, you'll be given the choice of having a debit card or a checkbook or both. Sometimes there might be a small fee to order an extra or both. But you'll be given that option. And when you go to see your doctor, if the money is already in your health savings account, you can provide that debit card at the point of service. But let's say you don't have the money in the account yet. You have the account established and you have a couple dollars in there, but maybe not enough to cover your full visit. You can pay the doctor using your funds that are not HSA, your own checking or savings, and then have yourself reimbursed out of your HSA, meaning you can take advantage of the pre-tax by putting the money in the HSA and reimbursing yourself. So the process is you really have some choice, and you'll find that different financial institutions will handle this differently, but for the most part, you're going to be doing it with a debit card or a checkbook.
The next question, what is the effective date of the $500 FSA rollover?
So FSAs typically are going to run on a calendar year basis, but there is a little bit of a grace period that somebody has at the end of the year to use up some of those funds. At the end of the year, that's when the $500 can roll over. And I will use this as a time to mention, if you find that you've got $500 rolling over, you really should be readdressing at open enrollment what you do for the next year, because you don't want to find yourself in that position. Everything above and beyond $500 is lost. And really, with an FSA, with the use it or lose it rule, it really promotes people to run out at the end of the year if they have money in their account and not use it with the best intentions, we'll say. That's when you find people running out buying cases of Band-Aids. So the $500 it has the ability to roll over. It's run on a calendar year basis. But again, you don't want to find yourself in that position. You want to utilize the calculators. You want to start low, ramp up if you need to. Nobody should have $500 rolling over in their FSA. We should really be working together to get that at a more accurate number.
The next question, what would happen to an employee's HSA funds at death?
An HSA account, you do have the option to either A, list a beneficiary of your HSA account. If there's no beneficiary listed, it would follow the state rules, which means it would go to the estate. But so if there is funds in your HSA at the time of passing and you've predetermined the beneficiary, those funds would be passed to the beneficiary. If not, it would go back into the estate.
And Craig, I'm sorry. One of the things I was just going to interject is it does have the capability to have multiple beneficiaries.
Yes.
So for that individual who wants to name more than one beneficiary, an HSA program does allow for multiple beneficiaries if that is so needed. Sorry, I didn't mean to interrupt, but just wanted to interject.
Okay, the next question. When you roll over the $500 for the FSA, does that contribute to the next year's contribution limit?
Joe, would you like to take that one?
Well, that's a great point. For most situations, that rollover basically is part of the total amount that you're able to put in there. So for the maximum contribution, if you have a rollover amount of $500, you would have to deduct that from what I understand under the FSA arrangement. It's not my understanding that you can contribute the maximum amount plus have that $500 over, because in my understanding, you would be overfunded in that situation. Is that your understanding as well, Craig?
Yeah, and just for clarification for everybody, this is the first year that the rollover was available. So
Correct.
Me chuckling and deferring that to Joe and him using the words "my understanding," we'll research that before the Q&A is actually provided. We'll make sure that the Q&A provides the 100% accurate answer. But the reason that both of us were answering it in that manner is this is the first year that the $500 is allowed to roll over.
Correct.
Okay, the last question. One of the participants on the call missed the part about what an HSA is and asked if you could briefly explain how that would work with an example.
Of course. Definitely we'll give a quick high-level overview of a health savings account. An HSA is a separate account that an individual or an employee of a group can set up if they have a qualified high-deductible plan. If they have a qualified high-deductible plan, they can put money into an account on a pre-tax basis. The money can earn interest and grow. They do not pay any taxes on the interest or gains. And they can use that money for out-of-pocket qualified medical expenses. It's really a vehicle to use pre-tax dollars to pay for your out-of-pocket cost. The government has some limits on how much you can put into an HSA yearly. They do review it and change that from time to time. Anybody can contribute to an HSA account, but the person who owns the account gets the ability to put the money into the account pre-taxed. It's a tremendous vehicle or tool to help people use pre-tax dollars, essentially saving money, using less money to pay for their medical expenses, while at the same time educating and really creating smarter consumers, smarter shoppers, helping us to take the approach with health insurance that we take with a lot of other things in our life. That was the quick high-level view. I do encourage you to talk to us more about one, two, or all three of these options. These are not the best fit for everybody, and not all of these are the worst fit. It depends on each company's situation, but we would love to talk to you to determine how these may work for you. And lastly, I just want to quickly talk about our next installment in our WebEd series. We're talking about creative funding, and the next one is going to be another part in the creative funding strategies. And as employers are looking for new ways to deliver health insurance to their employees, spending accounts are just a couple of those options. Next time, we're going to talk about a defined contribution model partnered with private exchange, another way that businesses can help control their costs and save money. So join us for that, and thank you so much.